We're in a very privileged position as UK Wind in that we organically generate capital that we can allocate to the advantage of our shareholders. And in this quarter alone, our cash generation exceeded our dividend by around 3.5 pence per share. So we'll now allocate that wisely to the advantage of our shareholders. And as a first step, in the quarter, we repaid 30 million of our revolving credit facility.
Hello, you're watching Proactive. I'm joined by Matt Ridley, partner at Schroders Greencoat, investment manager for Greencoat UK Wind. Matt, very good to speak with you. You published your first quarter NAV update today. Can you give us an overview of performance for the first quarter?
Happy to, Stephen. Thank you. So looking at the fundamental performance of the assets, it's been a strong quarter. Wind generation was 4.2% above budget, and net cash generation, so the cash that we have in our coffers after paying all of our costs, was 131 million, and that is 2.3 times the dividend that we paid this quarter. There continues to be strong improvement in wind speeds. We have had a period of time where we've had lower than average wind speeds, and in the last 6 months, we've seen a reversion to norm, and that's continued into Q2, which is off to a strong start. Realized power prices in the quarter were ahead of budget as well. So all the cash that we're looking at now that's put into our NAV there is before the appreciation in power prices that happened in March and April. So all of that serves to underpin further our dividend target for the year, which is 1.7 times. We've also addressed the rate climate in our NAV, so we've increased our discount rates. We've also reflected the uptick in inflation in our NAV too. The two more or less cancel each other out from a NAV perspective, but in the end leads to a higher return. So our levered return from our portfolio is now 11.5%, which we feel is an appropriate balance for our assets.
Matt, last week the government made a number of announcements on energy policy, including the potential for the introduction of wholesale CFDs for renewable energy projects. Are you supportive of what was published?
So perhaps leaving aside the sort of early kiting of the messages, in general, the announcements could be very positive for our sector. The biggest news, which was trailed about a week and a half ago, was the decoupling of electricity prices from gas. And the government proposes to do this by introducing a voluntary contract for difference for existing renewable operational plants. This is actually something that we've advocated for publicly as part of our response to the review of electricity market arrangements. And we think if it's implemented well, it has the potential both to reduce costs for consumers, but also to provide another avenue of price certainty to generators. So if this is done very well, and we'll continue to engage with government on it, we think it could be a win for everybody. There are a few other announcements as well, nothing particularly exciting. That's the main thrust of it. And as we said, we think that can be very positive for the sector.
With the ongoing conflicts in the Middle East keeping energy security in focus, does that reinforce the case for renewables in the UK, Matt?
It does, yes, and the government's been very proactive in saying that. So if you want to think about security of energy supply domestically, renewables are fantastic. Once they're built, there's no typically input that you need. You need sun, you need wind. So it has the ability to buffer this country from future gas price shocks. And the central way to deliver this is to advance further deployment of renewables, but also to provide a mechanism that works well for existing renewables. And that in both cases is the contract for difference. So the government has announced that it expects to bring forward a further CFD allocation round for new projects this summer. So that's earlier than had been scheduled. And as I mentioned earlier, there's also the prospect of a voluntary CFD for existing generators. So very much so that renewables can certainly protect this country against future gas price shocks, and the mechanisms are being put in place by the government now.
Can you give us the outlook for UKW? What are you as a company focused on, Matt?
So our first priority always is to operate our sites well and ensure that we can harness the wind that blows and deliver cash flow to our investors. We're in a very privileged position as UK Wind in that we organically generate capital that we can allocate to the advantage of our shareholders. And in this quarter alone, our cash generation exceeded our dividend by around 3.5 pence per share. So we'll now allocate that wisely to the advantage of our shareholders. And as a first step, in the quarter, we repaid 30 million of our revolving credit facility. And that's in line with our immediate priority of reducing gearing below 40% to provide balance sheet optionality for the business. We also expect, as we have said in our results in February, to make a disciplined return to reinvestment, to bring in further assets or opportunities that will grow our net cash flow generation to our shareholders, further reinforce our CPI-linked dividend, and take advantage of the growing market for renewables in the UK.
Matt, I hope you'll continue to keep us updated on your progress. Thank you very much for your time today.
Thanks a lot, Stephen. Always a pleasure.
That's Greencoat UK Wind's Matt Ridley.